I've known Paul Volcker since I was an assistant secretary in the Treasury in 1992 or 1. And, of course, at that time, he had just left, relatively recently left the Fed, and I was frightened of even meeting him. I was so intimidated by this global figure. And he couldn't have been nicer and more interested in, helping me and supporting me. And we kind of kept up, and so he was really, it was a great person to know. And I've read I've read numerous accounts of his life, but this book, if you haven't read it, I think really sums it up really well. I don't think there has been a greater public servant in our broad area in our lifetimes. I mean, he really just did exactly what he thought was the right thing all the time, and he let the chips fall where they may. He was famously booed at a Washington Bullets basketball game when he had rates very high, and they were then called the Bullets. So he's a great man. I'm still in touch with him, and so I actually thought I should buy 500 copies of this book and just hand them out at the Fed. I didn't do that, but it's a book I strongly recommend, and we can all hope to live up to some part of who he is.
Great. So one of the things that the Fed has been doing over the past year is a strategic review of its policy framework. Just recently, we had a Brookings conference discussing inflation and inflation targeting and a reevaluation of perhaps the framework there. I'm curious how that research and review is evolving and your thoughts there.
So I think it's evolving very well. This was something I really wanted to do as part of my time as chair, and a number of central banks around the world have done these external reviews in one form or another, and I thought it would be just a good idea, a good time and a good idea for us to do it. And then when Rich Clarida arrived, there were only 3 of us on the board at that time. We were just having a hard time, getting through the day. But Rich took this on at the very beginning and has been a great leader for this. So we're looking at our framework, our tools, and our communications. We began with a series of Fed Listens events at all 12 reserve banks. I think the last one I'm attending, the last one tomorrow in Kansas City. I think we've done 14 of those, and they're very different. And lots of them are live streamed, and we're hearing from the people we serve mainly. So it's people who work and live in low and moderate income communities. It's labor unions. It's small businesses, and really what a maximum employment and price stability and growth mean to them. And I have to say, if you listen to one of these things and sit through it, it's quite striking. It really does. I think it sheds a different kind of light than we might ordinarily get just from all of the economics that we study. So we take all that on board, and now we're going through a series of board meetings at which we're looking at things like makeup strategies for inflation and our toolkit and how we communicate, and we're going through those things one by one. I think we're making great progress, and I'm hopeful that we will. I think the exercise itself is a big win and a big gain for transparency and process, but I'm also hopeful, and I believe we'll be able to come out with some innovations which will put us in a better place to serve the public. And I'm also happy to see other central banks around the world are kind of picking up on the idea and doing it. So
great. So you mentioned the toolkit, and certainly the toolkit over the last decade has expanded quite considerably for not just the Fed but other central banks. And as you consider the prospect of if we do see a full business cycle, what tools in that toolkit are you interested in using again? And then what tools do you not have in that toolkit that you hope to have?
As this audience will know well, the tools that we did use in the last financial crisis, of course, were rates, the federal funds rate, which we cut close to zero, effectively to zero. And then we also used fairly aggressively forward guidance, indicating that to the market, and this was at a time when the market was predicting lift-off and rate increases that were higher than the committee thought were appropriate, committed sort of semi-commitments to hold rates low for a long time. So that worked. And also large-scale asset purchases of longer-term securities, so which are a way of lowering long-term interest rates to support economic activity. So those are, I guess we need to stop calling them unconventional tools at some point, but those are the 2 new tools that we used during the financial crisis. I'm sure that we would use them again as needed and as appropriate. We don't see that now. We looked carefully at negative interest rates. I don't think that's something, I know it's something we didn't see as an ideal tool in our institutional context. And I think different central banks around the world did different things, and we can observe how those things work. But I don't think we regard that as a first-order tool or something we'd be likely to use. There are other things that we need to look at, and I would say yield curve control, sort of short-term yield curve control, is something worth looking at. It's not at all something we haven't looked at it, but it will be something that we look at when the time comes. And the last thing I'll say is I think our toolkit, we'll use it aggressively to the extent we need to to achieve our mandate.
So one of the questions I got from someone today who knew I was going to be asking you questions was, is there an unintended consequence of, in a sort of reasonable growth, low unemployment, near the target rate, inflation rate, is there an unintended consequence of easing into that environment? Does it actually signal a risk-off environment to participants or consumers, et cetera, and does it actually almost become a self-fulfilling prophecy?
I don't think we see that in the data. I mean, in theory, that's possible. I don't think we see it in the data. I do look at this as akin to the two instances in the 1990s when the Fed cut and then cut again and then cut a third time. In those cases, that happened to be the right thing, that they thought that was the right thing to do. So provided some support for the economy, and the economy took that accommodation on board and gathered steam again, and the expansion continued. So that's the spirit in which we're doing this. I don't see any evidence that monetary policy is reducing consumer confidence or business confidence, which seems to be focused more on other issues.